All right, so the authors are looking at how are momentum returns affected by different levels of capital investment by companies. And they use three different types of capital investment, or three different ways of calculating it. The first one is the capital expenditures scaled by the total capital assets on the balance sheet. Next, they have the change in those capital expenditures from year to year, and then they have a change in the accruals. So these are the descriptive statistics. This is the population that they're using to perform their tests, and these are the stocks on the U.S. various stock exchanges in the U.S. from 1965 through 2004. So this gives us the average characteristics of all of these stocks over that time period. So we see that about the capital expenditures on average are about 14.6% of the capital assets on the balance sheet. And these change year to year on average, pretty much zero. And same for the change in accruals. So the balance sheet stays pretty consistent from year to year on the average company in this population. And they've also got the median quartiles and the deciles, standard deviations. What's interesting to see here is that they've got a correlation matrix here as well, and we can see the correlation of the different capital investment calculations that they used. So we see that they're definitely positively correlated to each other with the capital expenditures versus the change in capital expenditures. Same for the change in accruals and capital expenditures, so on and so forth. So the different variables that we use are somewhat positively related to each other. And we also see that the capital investment isn't really correlated with firm size here on average. And this is important to think about because historically size is a factor in determining future returns. And if we could say that these capital investment aren't related to size, then if we do have an outperform or abnormal returns from these factors, then we could say it's unrelated to size of the companies. Alright, so now that we understand our population set, we are going to explore the momentum returns at different levels of capital investment. Okay, so what we have here is in momentum strategies, you have formation periods, that's the J, this is the number of months to go back and see what are the past returns. And then we have K periods, which is the holding period in number of months, so 3, 6, 9, 12. And so we're ranking these stocks in order of past returns and then seeing what was the return over the next holding period. And so this space right here is somewhat descriptive statistics of the formation statistics, and then right here is the actual returns. And now for each of the holding periods, 3, 6, 9, or formation periods, excuse me, 3, 6, 9, and 12, they've sorted the portfolios into the lowest returning over that past 3 months, all the way to the highest returning over that past 3 months. So from R1, R2, R3, 4, and R5. And so in prior studies, we typically see that the past losers typically outperform the past winners outperform past losers. And if we're going to look at this R5 minus R1, that would be the zero cost portfolio here. What's the difference between these two? Then you see in all cases it's positive, so the past winners outperformed the past losers, and these are average monthly returns. So we see there's an excess abnormal return here at different levels for different formation and holding periods. But what the authors are wanting to hone in on is what for these types these levels of momentum, what was the capital investment across those firms? And for the capital investment, capital expenditures here as a percentage of capital assets, we're getting sort of a U shape where the capital expenditures are lower at the R3 level than they are at the R1 and R5 level. And this works out at each formation period. We do see, however, that the top returning portfolio, the R5, tends to have less capital investment than the bottom one. And although these capital investment figures aren't monotonically decreasing, it seems apparent that the higher returning portfolios are brought on by companies that have less capital investment. As we see that this is less than that, this is less than that, this is less than that, this is less than that. And so next, to really drill into this, the authors are isolating the formation period and holding period of 6 months. So when forming the portfolios, they ranked the stocks based on their past 6-month returns, then formed portfolios and held them for the next 6 months and looked at the returns. And so then the different panels here have the different calculation for capital expenditure. So here's the capital expenditure scaled by capital assets. Then we have the change in that capital expenditure, and then the change in accruals. And so from a momentum standpoint, we have the R1 portfolio, which is the past losers, and R5, which is the past winners, and that's for each of the capital expenditure calculations here. And then we also have the level of capital investment, with V5 being the highest level of capital investment and V1 being the lowest level of capital investment. So as an example, if we take this one here, this portfolio is composed of the stocks with the highest past 6-month returns and the highest level of capital expenditure scaled by capital assets, and that portfolio returned 1.69% per month, with a statistically significant T statistic here. And so what we want to hone in on here is the zero cost portfolio here, which is the R5 minus the return of the R1. So we can see the difference between those two is 0.57 per month. But what we want to specify is that as the level of capital expenditure increases, so does the momentum return. And we only really see that monotonic increase, aside from this, in the capital expenditure piece, not in the change in capital expenditure or the change in accruals. Those tend to be more of a U shape. And we do see, however, in all of these different measurements of capital expenditure, the portfolio that returns the least is always the V5 R1. So the loser with the highest capital investment. So we've got that here in 0.5 when we use the change in capital expenditure as well as the accruals. And so next, as a robustness check, the authors are looking at the returns of the zero cost portfolio from the prior table, but for different sub periods. So we have 65, 74, 75, 84, and so on, for the different measures of capital expenditure and at the different levels from V1 to V5. And so as we saw in the previous tables, when we're looking at capital expenditure, The momentum profits tend to increase monotonically in most cases as the level of capital expenditure increases, and this has happened over each of the subperiods. And then when we're looking at the change in capital expenditure or the accruals, we tend to have more of a U shape in the momentum returns. And so next, the authors did a 10 by 3 sort for the different levels of momentum. So the 10 being deciles of momentum level, and then 3 being 3 categories of capital investment. And so they're looking at the formation period and the holding period. So the formation period of being either 3, 6, 9, or 12 months, and then the holding period being either 6 or 12 months. And looking at the different levels of investment here from lowest to highest investment. And so this is somewhat similar to what we looked at before with the 6-month holding period. With the 12-month holding period, we see it's still in line with what we looked at before, where there's a monotonic increase to momentum returns. And so this would be the zero-cost portfolio returns from the 10th decile, the past winners, minus the first decile, past losers, at the different categories of or different levels of investment, capital investment. So we see there's a monotonic increase in returns with each increase in the level of investment, at least with the capital expenditure measure. And in line with the prior tables, we see that the change in capital expenditure has sort of a U shape in returns as the level of capital expenditure increases from the prior year, and same with the accruals. And so next we have the Depalma-French 3-factor model. So basically a regression that has the market return, the size factor, as well as the value factor, to see what are the excess returns after controlling for each of those factors. And that's what this table has here, is all of the alphas. So these are the risk-adjusted returns for the level of momentum, level of past returns, losers or winners, and the level of investment, capital expenditure. And so the first thing we see for the capital investment panel is that the portfolio with the highest alpha, the highest risk-adjusted return, is the one with the highest past winners and with the highest capital expenditures. And also the one that had the lowest alpha was the highest investment and the past losers. However, we see here that in the next panels that the highest returning portfolios are those with the lowest investment and the highest past winners. But it's interesting to see the only monotonically increasing relationship with capital investment is that of the highest momentum portfolios in the capital investment panel. The other ones have a decreasing monotonic return as the level of investment increases. And once we get into the change in capital expenditure and the accrual type of calculation of investment, we see that the returns decrease as the level of investment increases. So really the only one where you're doing well to buy companies with high investment is when the momentum is high and when you're using the capital expenditure scaled by capital assets.